So thanks a lot for having me here, for including the paper on the program. And it's a great honor to be here and to receive the award even. And let me get things started. So this is a closet work with Yingxiang, who is a PhD student from UBC, and he'll be on the market next year. And with Casimiro, who is a legal scholar from Lehigh University. Title of the paper is Conflicting Fiduciary Duties and File Sales of VC-backed startups. In 2021, Sequoia, one of the largest VC funds, made the following statement. Once upon a time, the 10-year fund cycle made sense, but the assumptions it's based on no longer hold true, curtailing meaningful relationships prematurely and misaligning companies and their investment partners. So what Sequoia decided to do is to break the traditional fund cycle and restructure itself around a singular open-ended permanent fund so that they will not be forced to exit from their investment prematurely in the future. And this is considered as a radical change because traditionally VC funds face a limited lifespan ranging from 8 to 12 years. So this means that maturing VCs need to liquidate and exit from all their investment by the end of this lifespan. And the most common exit mechanism is through acquisitions. Having those very timely exits is extremely important for the survival of VCs because they need to keep their promise to their investors, the LPs, and return cash to them in a timely fashion so that it makes it easier for them to raise funds in the future. However, this limited lifespan also causes a lot of pressure to liquidate and sometimes misalign the interests of different shareholders. In particular, when there is a lot of pressure to divest, exits through acquisitions can be rushed and achieve a lower sale price. The lower sale price may still satisfy, VC's liquidation preferences because they have downside protection in those preferences. However, common shareholders could be left with little or nothing. So this speaks to or reflects a fundamental conflict of interest between the preferred and common shareholders because they have different investment horizons and they have different payoff functions. In a typical VC-backed startup, we have the entrepreneurs and some key employees too. They hold the common shares. Those are equity claims with the full upside and downside potential. We also have the VCs typically investing through convertible preferred shares. Those shares come with special rights. One of the most important special rights is liquidation preference, which basically gives the VC downside protection in bad states of the world. The common and preferred shareholders will then appoint board of directors with most of the time the control of the board given to the VC. Those board of directors will then, oversee the operation of the company, including initiating key transactions like mergers and acquisitions. However, the VC-controlled board or the VC-appointed board members, they face dual fiduciary duties here. They essentially wear two hats. On the one hand, they have to maximize the return, the value of the corporation for the benefit of the common shareholders. However, on the other hand, they are under contractual obligations and have very strong financial incentives too to maximize return for the VC fund and for its ultimate investors, the LPs. Luckily, those two fiduciary duties, they are aligned in most occasions, but they can diverge in key scenarios, including the one that I mentioned above in those transactions. And indeed, this is at the center of some recent liquidity-driven controversial transactions, triggering litigation on fiduciary grounds. So what happened in those cases is that VCs with preferred shares, they force an exit by acquisitions over and above the objections from the common shareholders. And then the common shareholders, of course, they are very unhappy. They sue or threaten to sue the board for a breach of fiduciary duties. And in light of this heated legal discussion, what we are going to do in this paper is to ask the following questions. First, are the sales by those maturing VC funds indeed underpriced and costly to the common shareholders? In other words, we're asking, are the evidence consistent with file sales in this VC setting? Second, given the conflicting nature of the dual fiduciaries, the legal environment, of course, matters. So does the court support the common shareholders when they sue, or vice versa? Importantly, can the law shape the common shareholders' hold-up power, their power to challenge against the VCs, and in turn discipline VCs' behavior in those exit decisions? To answer those questions, we are going to carefully examine sales of VC-backed startups along the life cycle of a VC fund in a changing corporate law environment. More specifically, we are going to exploit an important Delaware court ruling in 2013. This is a trade-off decision which essentially establishes the rule of common shareholder value maximization. And broadly, you can understand this as moving from a more preferred favoring regime to a more common favoring regime. So what do we find? So first of all, in terms of the transactions, we find that the transactions by VC funds under liquidity pressure are characterized by the following three features. First, we see a substantially lower sale price, up to 30% lower. Second, we also see a greater probability of industry outsiders as the acquirers. So this includes financial companies, also those PE investors too. On top of that, we also observe a positive abnormal return for acquirers around the deal announcement. So this suggests the acquirers really take advantage of the target, and part of the target's loss become the acquirer's gain. So these three pieces of evidence really kind of, give us evidence consistent with fire sales, which means that, it's really costly to the common shareholders because they are the residual claimant here. Interestingly, things seems to be changing after the trade-offs ruling. I already mentioned that this is the rule of common shareholder value maximization, giving the common shareholders more power to challenge the transactions of the VCs. So what we find is that after trade-offs, maturing VC funds, they are less likely to exit by those fire sales. And as a result, because they have less proceeds from those fire sales, they are going to distribute cash to their investors, the LPs, in a less timely fashion. And on top of that, we also find evidence consistent with negative ex-ante effect that VCs, as a result of all this, experience more difficult fundraising ex-ante. So this kind of highlights very important trade-offs in fiduciary duty design, more specifically to this VC environment. I'm going to be very brief on the literature. So here, first of all, it speaks to law and finance literature, especially the work related to VC activities, and also the work related to fiduciary duties as part of corporate governance. It also speaks to VC literature and the fire sale literature. All right, now let me move on to the data and empirical setting part. I'm going to show you some results. So things here unfold in two parts. First part, I'm going to talk about evidence consistent with VC fire sales. The data source is quite standard here. We combine Preprint, which covers venture capital deals, with SDC Platinum, which gives us acquisition-related information. So the result of this is a cross-section of VC-related acquisitions with information on deal characteristics. In the language of Schleifer and Vishny, fire sales are forced sales at potentially dislocated prices, right? So one key task here is to identify those forced sales in the VC setting. So what we did here is to define forced transactions as sales close to the end of the traditional fund lifespan. So the key here is to first figure out this exit date for the portfolio company, okay? And then we can look up the names of the VC funds to know, what is the vintage year of the fund. And then we can calculate, the difference between the two that gives us the age of the VC fund when the transaction takes place. With that, for each fund company year, we can then define if the transaction is forced or not. And the definition here is very similar to Campbell et al. 2011 AER paper, where there is a forcing event. So here we define this forced minus T plus T dummy equal to 1 if transaction takes place within T years of the end of the conventional lifespan, and 0 otherwise. And this window length T here can take the value of 1, 2, and 3, capturing the urgency of the deal. We choose the conventional lifespan here to be 12 years. You might think that this is a bit arbitrary, but it's actually supported both by anecdotals and by patterns in cash distributions of an average fund. There are a lot of papers, so I listed a few here, that document VC funds are organized to have a limited lifespan of 8 to 12 years, often with an option to extend it for 1 to 3 years. So we just take, the most frequent value here, 10 plus 2, which equals to 12. And we also take a look at the patterns from cash distribution. So we look at the detailed cash distribution data, and we try to see, towards the lifespan, where does the distribution take place. We can see in this figure that there is, the solid line. This is a median fund, and you can see that at age 12, 92% of the cash distribution takes place, and 100%. Moving to 15, you can see that it's very close to 100% that is taking place. So this is consistent with the pressure, pressure to liquidate around those years. With the definition, we can take a look at the regression equation here. It's very straightforward. We have the force dummy, and the outcome variable here can be deal value, deal multiple, acquire industry, and also acquire CAR. And we have a lot of control variables here, a lot of fixed effects. Controls include both company and VC level controls to make the comparisons more fair. All right, let's take a quick look at the key results here. First, the value of the deal. So here, column 1 to 3 will be the log value of the deal. And you can see that the coefficient tends to be negative and significant. The first column is forced -1 to +1. So this is the most urgent sales. And that indicates around 30% discount for the sales in the final year of the conventional lifespan. And moving from column 3 to column 1, you can see that the discount increases, which is consistent with the urgency of the transaction. And column 4, 5, 6, you have similar findings. Again, evidence for undervaluation when looking at deal multiple. Secondly, we take a look at the identity of the acquirer. We want to see if the acquirer is coming from, outside of the industry or inside of a certain industry. And here, column 1 to 3, we look at remote industry. So this is based on the product market overlap between the acquirer and the target. As you can see, there is now a positive coefficient suggesting that companies in forced sales are more likely to be acquired by those industry outsiders. Column 4, 5, 6, we look at whether the acquirer is a financial acquirer, most notably PE investors. And indeed, again, the coefficient is positive and significant. And we can interpret those evidence as consistent with assets not being sold to the highest value bidders, because the highest value bidder typically come from within the industry who have the highest, the best use of the assets being sold. All right. And in the end, we look at CAR. We look at the abnormal return experienced by the acquirer. And here, first 3 columns, we look at CAR over 10 days around the transaction using CAPM model. And 4, 5, 6, we look at Farmer-French 3 factors as the underlying benchmark model. And across all specifications, you can see that the coefficient is positive, mostly significant, suggesting that the acquirer is getting something out of those deals. And again, moving from column 3 to 1, it increases. 6 to 4, it increases with the urgency of the sale. And we interpret this as evidence that acquirers, they really gain at the cost of the target that is being sold at a discount. Well, one concern that you might have at this stage is that there are selection issues here, right? It could be that the assets being sold later are not the same as the firm being sold earlier, and VCs might indeed wait longer on bad startups. In the paper, we did a lot of work trying to argue that this is unlikely to be fully driven by selection. For example, for a subset of firms, we actually can see the sales and the employment, the fundamentals of the company, and we can use the future sales number as a control in the regression, so that captures part of the future growth opportunities, and we again find very similar results. And also, selection cannot really explain greater probability of acquirers being industry outsiders or higher abnormal returns for acquirers. So those results are consistent with theories of fire sales and are rather unique markers of fire sales. We also look at market downturns where the M&A market freezes, and there we see a stronger effect because it's more difficult to find a potential buyer. So we think, with all this evidence, it's very consistent with the fire sale story. Unlikely everything is driven by selection here. The second part of the paper is about the trade-offs ruling. Let me quickly talk about the Delaware corporate law before trade-offs kicking in. So there is a 1997 Delaware court decision saying that the board may deploy corporate power against its own shareholders. This is consistent with the contingent approach theory. Basically, the VCs control board, they can make decisions that are in favor of preferred shareholders at the expense of the common shareholders. As a practical matter, this is interpreted as a pro-preferred regime. So this is what happens before trade-offs. And then we have the trade-offs case. So in this very case, trade-offs is a firm that was sold for a total $60 million US. So VC-controlled board forced the sale in 2005. And out of the 60 million, 52 went to the VC because they have liquidation preferences. And then 8 million went to the management because they have some bonus incentive plan. And then the common shareholders, they are left with nothing. They are totally wiped out. And the common shareholders sued on fiduciary grounds, claiming that the board making decisions in this case is conflicted. And after closely examining the case, the Delaware court concluded that indeed the board was conflicted, and then they endorsed the rule of common shareholder value maximization in 2013. And this is taken from the original ruling, basically saying that the board should prefer the interest of the common stock to the interests created by those special rights, preferences of the preferred stock. And as a practical matter, we can say that it's moving from pro-preferred to a pro-common regime, where the common shareholders are now given more leverage to challenge the sales of the VC-backed companies. So with this case in mind, we are moving to empirical analysis. So here, we use a definitive setting, basically comparing, sales or probability of exits through acquisitions by VCs with and without liquidity pressure before and after the trade-offs case. Here are the results. We find that indeed, the coefficient on this definitive term, on this interaction term, is negative and significant, suggesting that trade-offs is going to lower the probability of sales happening around those years where fire sales are likely to take place. And of course, you might have some identification concerns here because the past 10 years has been the years where the VC industry is growing rather well and the environment is becoming more pro kind of entrepreneur, right? They are very entrepreneur friendly because of the influx of capital into the VC industry. So that might explain some of the results. They kind of give more preference to the entrepreneurs. Well, we try to argue here that this does not explain the full story because we can do this triple difference based on whether the firm is incorporated in Delaware or not. We take advantage of the fact that this is indeed a Delaware decision, so it should be applicable to Delaware incorporated companies. We manually check the business registry of different states to make sure where each of these startups are being incorporated. And then we do this triple diff regression. And you can see that the coefficient for this triple diff regression is negative and significant, suggesting that there is much stronger effects if the companies are incorporated in Delaware. So trade-offs is powerful in Delaware only, not in the other states. And with less cash flow from those forced sales, we find that the trade-offs is going to also lead to less distribution to the LPs, less timely distribution to the LPs. Dynamics very standard. We try to see if there are pre-trends, if things only show up after the trade-offs decision. And as you can see, there isn't much happening before, consistent with trade-offs being an important but rather surprising event. Very end, we look at ex-ante effect. We look at the supply of venture capital and the fundraising of the VCs. We find that there is less investments from foreign LPs in the US VCs. We also see that there is less capital raised by startups when we compare US with the other countries around 2013. All right, I think I'm running out of time. Let me just quickly conclude. So this paper, we show that there is evidence consistent with fire sales in the VC setting. And more importantly, we show that the court ruling can really change the dynamics of fiduciary duty conflicts. And taking everything together, this underscores the complexity of evaluation of the trade-off decision and the resolution of inter-shareholder conflicts, and has important implications for the design of optimal fiduciary duty going forward for the VC industry. And finally, let me also just quickly talk about this corporate law's functional limitations. We know that existing corporate law is mostly built for public, closely held corporations with a homogeneous shareholder base. But for VC, it's very different. It's a different animal, having very different, very complex financial structures and have very complex contractual rights. We should really think about how to make the law more accommodating for the VC investment. All right, that's the end of it. Thank you.
Thank you for the organizers for having me discuss this paper. As you know, it won a Best Paper Award, so I have my work cut out for me, given that everybody, and it deserves this award, it's a great paper. But this is not the author's first rodeo, all right? This paper is 99 pages long with a 41-page internet appendix. It has had 10 discussants before me, which I am sure, if you look at the names of those discussants, I am in really august company, and they have done a fantastic job. So where can I add value in a paper that's had so many people discuss it and give feedback, all right? So I'm going to not go much over what the findings are, because obviously Bo did a fantastic job, and there's no need for me to reiterate it. But obviously the premise is that the general partners of a VC fund have a conflicted agenda. They wear two hats. On the one hand, they want to maximize their limited partners' returns. On the other hand, they're supposed to have a fiduciary duty to the common shareholders of the firm in which they invest, of their portfolio firms. And so Bo has presented a number of tests to show that when the fund is entering toward the end of the life, they want to go ahead and return that money to the LPs, and therefore may engage in fire sales in which they get a lower price than potentially they should have. I'm not going to quibble with this interpretation. One, she gave some idea that it isn't that these companies are in the portfolio longer because they are of lower quality. Maybe they are, maybe they're not. But let's assume, go ahead, we're going to assume that these are fire sales and that this conflict is important. So the question remains, what is this? What are the impacts on fiduciary duty? Right, so I'm going to focus more on the second half of the paper and not the first half. All right, so as you know, she discussed trade-offs, but she left something kind of important out. So I will talk about that. So the preferred stockholders in the portfolio firms only have a conflict in acquisitions, because if they do an IPO, their preferred stock goes ahead and converts into common, which then aligns their interests with the shareholders of the firm, right? So the court deemed the process very flawed, and in fact, this was also a similar case was brought in called 9 Systems, in which they came to the same conclusion, that the way that the VC board members decided to sell the company didn't do their full due diligence. But what they also found was that there were no damages to the common shareholders. That in fact, even though the process was flawed, common shareholders did not have any ill effects from it monetarily. And I think that's very, very important here, right? Because when we're going to talk about the trade-offs of how you implement acquisitions or sales of portfolio companies at the end of the portfolio life, if there are no damages, then perhaps you change the way you do it, but you don't have to worry about losing a lot of money. Now, that being said, the case took 8 years to get to court, so there are a lot of managerial time that's used to fight that case, and of course there will be attorney's fees associated with it. And in 9 systems, they did award the plaintiff's attorney's fees at the end. So there could be some cost associated with it. So what was the response to it? So this paper does a survey of attorneys after the Trados decision to ask them what did they do differently after this. And you can see that really not a lot changed, all right? So even though the Venture Capital Association changed the shareholder agreements to try to indemnify directors with respect to their liability on fiduciary duty, there wasn't really much uptake, and Bo mentions this in the paper, but it hasn't really meaningfully done much to those agreements. Now the process changes, right? So the process changes where they do better due diligence, they consider alternatives. When I was at the SEC, we revamped our economic analysis, and the first thing we had to do is consider all the alternatives and make those public, all right? So it's a very similar one. They can't just pick one. They have to look and justify what they're doing. And they could, at the margin, allocate money to common shareholders, even if they do not deserve money, right? Now, not everybody agreed with this decision. Both cites a paper by Senga and Talley that model this VC decision. And just briefly, we're economists here, obviously preferred shareholders have a very debt-like claim on the firm. And if these firms are indeed not worth the money not worth very much money, and they're being sold in a fire sale, the interests of the preferred now become common, right? And so the preferred shareholders are the ones whose value maximization the fiduciary duty should go to, rather than to the common shareholders whose value is zero, right? Because we know once a firm, the common shareholders are wiped out, debt holders become essentially equity holders, right? So it's not clear that the court understood this very well, or that the sale in the Trados decision was understood. It was clearly not worth anything because they did not give the common shareholders any monetary damages in the case, all right? So, in this case, there may be some additional thinking about it. This is a very nice model that tries to see when you should go ahead and use preferred shareholder as the main claimant on the assets of the firm rather than common shareholders, right? So what I want to know more about in the paper is how do VCs view this trade-off? There is a cost-benefit association with deciding what to do during this acquisitions. Now, the results that are presented suggest they just do fewer of them, but that's not very satisfying because these companies are still in a portfolio, right? So you can't you're going to still have to give your money back to your LPs at the end of your fund life, and so these companies have to be sold or given to another fund, and we'll talk about that in a minute. But of course, when I think about being a general partner in a venture capital fund, if there aren't any monetary damages with respect to violating Trados or looking like you violate it, why not go ahead and do that, right? And take your chances that somebody will sue you, which is going to be unlikely because these plaintiffs, it's a lot of money for them too, 8 years of still having to do it. And then give your money out to your limited partners and start your new fund because your new fund's going to be great, right? You're going to get more money. You're going to continue to have jobs. And so it seems to me that the costs of potentially looking like you violate this by having a fire sale seem a little bit lower to me, all right? There are papers that look at the probability of being sued. It is 4%, which you can argue is big or small. And most of these, when they do lose, damages are very high when it is against a founder of a firm. So there is some definitely on the benefit side of not doing this. So one way to look at this is to see whether the incidence of lawsuits change after this decision is made. So the findings or the empirical analysis here is somewhat less satisfying than the empirical analysis on whether or not it's a fire sale. First of all, the indicator variable is just a year variable. It's 2013. And as we know, that may capture trade-offs. It may capture something else that happens within the venture capital industry. It's not a very precise measure with respect to this decision. Now, the authors do present information on, for example, whether you're headquartered in Delaware. It's not headquartered, but incorporated in Delaware. But most of the companies are. It's an endogenous decision, right? So the 20% that don't incorporate in Delaware may be very different than the 80% that do. So it's not clear how that happens. And they compare the probability of acquisitions, which she didn't present, between venture capitalists and funds of funds. Again, it's not clear that this captures trade-offs that well. But what is not presented is what is the characteristics that make a fire sale. So there were very convincing results that a fire sale results in lower multiples, lower deal values, and having more of an outside acquire and acquire returns. So what I thought I was going to see was an interaction variable on all of these things, right? That we would expect the incidence of fire sales should go down, but also the characteristics that define a fire sale should also be decreased. We don't see that in the I don't have any information about that. And again, what is happening to these firms if VCs are no longer selling them, if the probability of acquisition has declined? Well, what are these funds doing? She has many fixed effects, and so therefore, some of this may be captured within the fixed effect. But an interesting paper, which I'm not going to say the author because maybe someone can say the author's name, with Paul Gompers, I'll just say that, find that acquisitions tend to be, they find a positive response on acquisitions, particularly those that are relationship-based. So that there's another conflict here that may exist, not just with the common shareholders versus the preferred, but also that the general partners of the VC fund want to give their other portfolio companies a good deal on a company that they need to get rid of, right? So this is a related transaction in some sense. And the question is does this incidence of related transaction go down after trade-offs? Now, trade-offs doesn't address this, but certainly the sort of theme of that ruling would suggest that related transactions would also violate fiduciary duty. This is a corporate governance symposium, so I'd like to know about the corporate governance. Now, there are more findings she did not present because it's, again, 99 pages. So there are many, many findings, but one finding she has that looks at proxies for the influence of the venture capital on the board. One of them is, do they make a larger investment? And the other one is that board has fewer investors, and so therefore you would have more influence on the board. But there have been other papers that have looked at this. For example, the bargaining power by Ewens and Malenko. They use something that could definitely be calculated very easily, all right, is to look at how much bargaining power the VC might have. And really, the gold standard would be to see what kind of governance they actually do have on the board. How many board seats do they have, right? How much influence do they have on the voting? Because obviously, if there are more investors, as they show, they're going to have less influence. But I'd like to know more. And I'd also like to know the number of independent directors. Does that matter? Does the ability of the venture capitalist to expropriate common shareholders differ by the composition of the board? What happens to individual VCs after this, right? So all these VCs, we have a VC fixed effect, but I want to know who are the say, worst offenders for fire sales, right? And does that behavior change more, or more sensitive for those worst offenders? So for example, does the weighted average discount from the sale of assets during that forced period predict the ability of the fund to change their behavior? Maybe they raise more capital, for example. Are fire sales related to misconduct? On Form ADV, you have to give information on whether there's misconduct in any fund, and you could look at that. There's a working paper coming out that looks at that might be useful to seeing what's happening there. And so while the paper shows that US VC funds raise fewer funds after the decision, as compared to foreign VCs, again, it's just too broad for me to actually tie that into trade-offs. I'm going to go ahead, since I am almost out of time. All basically here is that whether or not startups are more or less likely to go into Delaware, they show a chart that says it isn't, but we don't know any heterogeneity about that. We just know an average statistic. I'd like to know more. And so what I want to conclude is say this is a super interesting paper. It is notoriously difficult to examine fiduciary duty. You have to have a shock, right? And the only shock I can think of lately is the DOL's decision on broker-dealers, which was then overturned by the courts. And so I think it's an important paper. It's well deserving of the Best Paper Award. And I wish the authors the best of luck.
Thanks so much, Kathleen. Well, any comments?
So first of all, thank you, Catherine, for this super informative, super insightful discussion. A lot of food for thoughts, and definitely there are new tests that we can do, as you have pointed out.
And more pages to add.
And make sure that it's not going to cross 100 pages. And but yeah, we are planning with actually connecting the information on Form Ds, and definitely we want to look at the directors, as you have pointed out, independent directors, and what is the formation of the board. And you have also pointed out that it's interesting. It will be interesting, I think, to look at relationship-based acquisitions, because this is kind of also hard evidence on those transactions are really problematic. And I think it's a good idea to take a look at that. And a few other things that you have mentioned, I just want to clarify a little bit. So acquisitions, yes, it's a good question why we only look at the extensive margin but not the intensive margin. The reason is that we didn't really see much effect at the intensive margin, and this is because we are not comparing, the same thing before and after, because a lot of the transactions are being avoided, right? So the transactions that stay there, they are not really directly comparable to the transactions that happened before. So I don't even have a strong prior in terms of, which direction the effect should go. And about the discussion of the theory and also Cable's interviews, of course, they are very important. They are kind of, the earlier work in the trade-offs area. The Cable's paper is based on anecdotals and interviews, and Senga Tali is kind of a pure theory piece of work. And we thought, as empiricists and as people dealing with data, it's important for us to see what really happens with data. So we are kind of more presenting evidence without much prior on what is happening based on the interviews and anecdotals. So this is kind of what we are happening, and I agree with you. Maybe we should be more careful in terms of interpreting some of the last set of the results. For example, on the capital raising and on the supply of venture capital to the startups. Great, thank you.
Thank you. Thanks to both of you. Heck of a job to do 99 pages so sharply and succinctly. We perhaps have time for one question.
Yeah, so my question is, if you think about venture capitalists, they're also value maximizers, right? So ex-ante, they don't like fire sales either. It hurts their benefits. So I'm not sure this is like ex-ante conflict of interest or moral hazard on the VC side. It's more like, because they have a cycle, they know that they have to exit in 12 years. So it's unlikely they're going to go ahead and invest in a company 2 years before they close, right? Before So they don't do that. So they invest in a bunch of companies in the early stage, and then it just, as it is, that some companies just take longer to sell, and just inevitable. Like you have a portfolio of firms, and then some are going to take longer to sell, and end up selling them towards your cycle. And also these portfolio companies, when they get a VC funding, they know that these VC, they need to exit 5 years, 6 years down the road. So there's no like asymmetric information there either. So I'm not sure this is like conflict of interest, or it's just it's something that's bound to happen because some companies just take longer to sell. And I wonder if you have the data on if these companies do take longer to sell, like they have been invested for longer periods.
I think that it's a very good question, very fair one too. I think that another way to ask the question is, what are the external shocks? What are the kind of the random things happening that cannot be expected that is triggering some of the sales, right? You are basically saying that there is a lot of information, there's no asymmetric information, and a lot of things are already known, like they can plan for those events. But what I'm trying to argue here is that in terms of the realization of the value of the company, there is a lot of randomness. So down the road, it could be that all of a sudden they realize that the firm is a mediocre one, because of an industry shock, because of some other events, and then it triggered kind of at the end of the lifespan a sale. So there are kind of other factors that go into this decision, rather than everything can be planned ex ante. Thank you.
Okay, thanks so much. I think given timing, we should move to the coffee break. The Weinberg Center has organized a coffee break out in the hallway before the second session. Thank you so much to everyone. Ken?